Today really feels like one of those pivot points, the kind that's
Again, historians look back on.
exactly
Yeah.
for decades, because we've just come out of a 10-year cycle where global capital markets were just completely obsessed with software, with the digital world,
Purely virtual asset.
really virtual assets. But the deep reports we've pulled for this dive are, I mean, they're practically screaming that the world just slammed on the brakes and pivoted hard back to the tangible.
Back to hard assets and emerging markets.
Yeah.
And what makes this moment so significant is this perfect storm.
Right.
3 huge, seemingly unrelated events all happening today, January 6th, 2026.
And they are.
We're talking about a dramatic political shakeup in Venezuela, the debut of the physical AI revolution from CES, and then this rising geopolitical friction in the Arctic.
Okay, so on the surface, totally separate stories.
Totally. But when you look at them together, they're not random headlines. They have a single, coordinated signal. And the core issue is this. The pricing power of global assets is fundamentally shifting away from pure growth projections
And moving toward what?
toward resource control and industrial capacity.
So our mission here is to connect those dots for you. We're going to show you exactly why this convergence matters and how it forces a completely new calculus for understanding the global economy. This dive is your shortcut to that new understanding.
To get to that insight, we need to move quickly but thoroughly. So let's start where the biggest geopolitical uncertainty of the past few years just evaporated, South America.
That's right. The immediate news focuses on former Venezuelan President Nicolas Maduro.
His first formal appearance today.
In the U.S. District Court for the Southern District of New York, the SDNY as we call it, on charges including narco-terrorism, this is a huge deal. It removes the largest political risk overhang in the region.
And here's the nuance, the really interesting part for the market. It's his legal strategy.
Okay.
Maduro's defense team adopted this aggressive, almost provocative stance. They're arguing that because he was a sitting head of state who was forcibly removed by what they claim was a hostile nation,
Right.
he should be given prisoner of war status under the Geneva Convention.
Not face criminal prosecution at all.
Exactly. So instead of fighting the charges, they're fighting for a completely different legal status. They're turning a criminal trial into an international diplomatic spectacle.
And the markets, they like that. That sounds messy.
Well, the legal wrangling will probably occupy the news cycle until 2027, but capital markets don't actually mind the duration.
Why is that?
Because prolonged legal stability, meaning the situation is contained and predictable, is often way better than a quick, chaotic transition of power. For investors, the key is that the political uncertainty is gone.
That stability is the green light.
It is. It allowed the new acting government, led by acting President Delcy Rodriguez, to pivot immediately. Her whole inauguration speech was just pure pragmatism.
Economic reconstruction.
Exactly. The ideology's out the window. She's focused on pragmatic survival.
And pragmatic survival in Venezuela means one thing.
Oil. It always means oil. Venezuela holds the world's largest proven reserves, and the new administration is already talking to Washington and the IEA to get their facilities back online.
And I saw some reports that U.S. Special Forces are already on the ground.
They're reportedly assisting in securing those critical fields around Lake Maracaibo.
That's a crucial detail. So if they manage to bring this supply back online, what's the structural impact on global energy prices?
It's structurally significant. Analysts are anticipating a measurable rebound in crude output within, say, 6 to 12 months.
That's fast.
It is. And this influx of non-OPEC supply is seen as a critical counterweight to all the instability in the Middle East.
Yeah.
It basically helps cap long-term oil price spikes.
A new stabilizing factor.
A major one.
And Wall Street certainly noticed. We saw a furious rally in Venezuela's sovereign bonds today. Now, for anyone listening who may not follow this, these are bonds that have been in default for years. They haven't been paying their debt. So why would major players like Goldman and JP Morgan suddenly jump into something that's functionally worthless right now? That just sounds like massive risk.
It is speculation, but it's informed speculation. It's a distressed play.
Okay, break that down.
So when a sovereign bond is in default, it trades for pennies on the dollar. The bet isn't on its current value, it's on the sanctions being lifted. That clears the way for a debt restructuring deal.
As that happens.
Those pennies turn into dollars, potentially making them the highest yielding distressed assets of 2026. They're betting on the predictability we were just talking about.
So the biggest value play of the year is betting on the return of predictability.
Exactly. And the most important part is the spillover. Capital is now re-evaluating the entire Latin American region.
A structural re-rating.
Absolutely. Equity markets in Brazil, Colombia, they rallied in sympathy because a stable oil-producing Venezuela boosts regional confidence. After a lost decade for LATAM, the bull market thesis is suddenly very real.
And that huge structural re-rating in emerging markets is being driven, ironically, by the absolute bleeding edge of technology. Let's pivot sharply from the Venezuelan oil fields to Las Vegas.
CES 2026, where the tech narrative just went from software code to commodity steel,
It really did. It all revolves around Nvidia CEO Jensen Huang's keynote.
where he unveiled the Ruben next-gen AI computing platform. For years, AI meant large language models, right? Chatbots, digital assistants.
Sure.
Ruben is the platform that moves AI out of the digital cloud and firmly into the physical world.
Okay, so if you know what an LLM is, what's the key conceptual difference here? What is a physical world model?
Think of it this way. A traditional LLM understands language, data. A physical world model understands physics, spatial dynamics, material stress.
Okay.
Juan declared 2026 the year of physical AI. He was emphasizing that AI is now driving embodied AI.
Which means?
Humanoid robots, automated logistics, fully automated industrial infrastructure.
Give us a concrete example of what a physical world model can do that the old AI couldn't.
Okay, picture a massive industrial warehouse. An old AI could optimize a route for a forklift.
Right.
A physical AI, with Ruben, can predict in real time the material stress on the forklift's arm as it carries a heavy load, anticipate a human worker suddenly walking by, and autonomously reroute itself while compensating for all those physical variables.
So it's dynamic real-world control, not just following digital instructions.
Precisely. And the implication for hard assets is instant and massive.
Because this physicalization of AI needs immense energy and materials.
Exactly. The strain on power grids from these new Ruben data centers and the sheer material demand for millions of robots it's unprecedented.
Which brings us to the specific financial shock today. Copper.
On the London Metal Exchange, the LME.
It historically breached $13,000 per ton.
And this is a structural demand shock, not just speculation.
Right.
Because copper is indispensable. Every single humanoid robot, every new high-speed data center that needs massive conductivity, it all requires enormous amounts of copper.
And supply is already tight.
Very tight. Key areas in Chile and Peru are already under pressure. So copper is cementing its new status. It's the oil of the new era.
The oil of the new era. That's a phrase that's going to stick. So what does this elevated demand for power and materials mean for where things get made?
It completely shifts the global manufacturing advantage. We're moving away from the era where the primary advantage was cheap labor.
Okay, so what's the new advantage?
It's decisively shifting to cheap power and proximity to compute infrastructure. This strongly benefits established industrial nations with deep engineering and energy resources. Think Germany, Japan.
And it challenges the low-end assembly markets.
The ones that lack the computational depth and the cheap, abundant power.
Yeah. That incredible demand for copper and compute power, it raises a huge unavoidable question, doesn't it?
It does.
Who controls the supply of the other critical materials? And that leads us straight to our third converging factor, the Arctic.
The Arctic Cold War is officially heating up. U.S. President Trump's renewed focus on Greenland, and this implication of an expanded military footprint there under the 1951 Defense Treaty, it's throwing fuel on the geopolitical fire.
But the real motive isn't just a strategic northern post, it's resources.
It's entirely about resources and security, specifically control of the vast rare earth deposits under the Greenlandic ice sheet.
The elements vital for everything from military hardware to the chips and robots driving physical AI?
It's viewed as the absolute top priority in the context of the accelerating U.S.-China tech war.
And this has naturally created intense strain across the Atlantic.
Very intense. Danish Prime Minister Mette Fredriksen's response was sharp. She warned that coveting an ally's territory marks the end of NATO.
Wow.
That statement is the core danger signal for the markets. It exposes the post-Cold War fragility of the whole alliance.
Because if that core trust in NATO is compromised,
The implication for Europe is existential. Nations have to drastically increase defense spending, reassess their reliance on the U.S.
and markets acted on that fear immediately. Capital just fled European risk. The euro weakened against the dollar.
And traditional havens benefited massively.
Gold.
We saw a significant rush into gold and the Swiss franc, the CHF. Gold is the traditional hedge, of course. But the run into the franc is a bet on neutrality.
Right. Switzerland's outside the Eurozone, seen as the safest financial harbor.
And when the political glue holding an alliance like NATO fractures, investors immediately move into assets they trust to remain separate from the conflict.
So the overall signal from this triple convergence, Venezuela stability, copper demand, and Arctic friction, is that resource control dictates both risk and return in 2026.
That is the structural shift. And to really solidify that conclusion, we need to widen the lens. Our sources identified 4 key shifts happening right now across Eurasia and Africa that all reinforce this trend.
This pivot to hard assets and financial autonomy.
Exactly.
Okay, let's start with India. It seems to have hit its super factory moment.
It really has. Today marks the official inauguration of that massive joint venture Gigafactory between Tesla and Tata Sons in Gujarat.
And this facility is planned to produce, what, 20% of the global capacity for the Model 2?
An estimated 20%. This is the tangible realization of the China Plus One strategy.
Where multinationals diversify manufacturing away from China. This scale suggests India is finally realizing its ambition to be the next world's factory.
Absolutely. Infrastructure and power stocks in India are going parabolic because it's now backed by tangible operational mega facilities. It's a fundamental supply chain shift happening in real time.
Meanwhile, Saudi Arabia is making its big post-oil bet.
Aggressively deploying their petrodollars. They're using the Public Investment Fund, the PIF, to make these strategic moves.
And today's announcement?
A massive $10 billion acquisition of a top European gaming publisher, plus plans for a global esports hub in NEOM.
So they're not just buying games, they're buying control of digital infrastructure and soft power.
They're recycling their control over a hard asset oil directly into cutting-edge cloud data and global tech equity. They're becoming the kingmakers in global tech.
And back in Europe, Germany is fighting to save its industrial core.
Which is being challenged by this new cheap power mandate of physical AI.
Right.
Germany's manufacturing sector relies on cheap, reliable energy. So today, the Bundestag passed the Green Hydrogen Infrastructure Act.
Which is a monumental effort.
It is. It approves a subsea pipeline from Norway straight to the industrial heartland of the Ruhr. This is Germany's multi-billion-dollar bet to save its manufacturing crown and decouple from sensitive natural gas.
A massive infrastructure play to maintain their advantage.
And finally, let's look at Africa, which is making a significant leap toward financial autonomy.
Nigeria's eNaira.
Their central bank digital currency. It just went fully live for cross-border payments, linking up major regional players like Kenya and South Africa.
That's a clear move to reduce reliance on the established global financial system.
It's a vital signal of the global South seeking financial independence. By bypassing the dollar-dominated SWIFT system for their own trade, they're lowering costs and challenging the old architecture all at once.
So that's 4 huge signals: India manufacturing, Saudi investing, Germany decarbonizing, and Africa de-dollarizing. They all point to the same conclusion.
The conclusion is solid. The core trend for 2026 is the return to the real. The world is pivoting from a purely virtual economy back to physical resources. AI needs copper, nations need energy. The investment logic has to expand from just growth tech to the underlying resources that support it.
So if you're looking for where that emerging market alpha, that outperformance will be this year, where specifically should you be looking?
We see 3 primary regions. First, Latin America is the top pick for value restoration, driven by the Venezuelan thaw and the commodity boom.
Okay.
Second, India is the undeniable primary beneficiary of supply chain relocation. Infrastructure plays there are key. And third, the Middle East. You have to watch their M&A activity in global tech.
And finally, risk management. We just saw NATO cracks form over Greenland, plus these de-dollarization efforts. How do you hedge against these new geopolitical fault lines?
Well, the signal from Greenland is clear. Increase your allocation to genuine hedges. First step is more gold. The second is looking at high-yield, non-USD currencies that benefit from this commodity shift.
Like the Brazilian real, which you mentioned. Why is the real a good hedge right now?
It ties directly to the commodity boom. Brazil is a massive exporter of critical resources: iron ore, agricultural goods, oil. If the world demands more hard assets and the dollar's dominance is being challenged, holding a commodity-linked, high-interest rate currency like the real provides a tangible buffer.
Got it. And for those heavy in European assets?
Remain cautious. The valuation risk won't clear up until the Greenland dispute is resolved and Germany's hydrogen transition is fully clarified. Until then, the political risk premium is high.
This has been an incredible deep dive, tying together geopolitics, commodities, and next-gen AI.
2026 is going to be a stock picker's year, driven by profound structural change. The big opportunities are no longer hiding in the obvious tech names, but within the nations and companies that control the resources, the energy, and the manufacturing capacity of the future. The physical world is back in charge.
And that brings us to our final thought for you to mull over. If copper is now the oil of the new era and nations are willing to risk alliances over rare earths under the ice, we have to ask, what other foundational, often overlooked resources like freshwater rights, specific agricultural land, maybe even deep-sea minerals are secretly positioning themselves as the next strategic choke points in this massive physical transition? You can't just track the app anymore. You have to track what the app consumes. Keep looking beyond the headlines.